Alright guys, this is a tutorial for beginners on how to trade supply and demand, and the type of supply and demand that I'm going to be displaying here and showing you guys is basically fair value gaps and order blocks. So fair value gaps are, actually no, we're going to do order blocks tomorrow. We're going to do fair value gaps today. And so the first thing you need to know when you're looking, because I know it's confusing when you have all these different trading strategies on YouTube and you don't have like a clear plan, and that's what you're looking for is a clear step-by-step plan on like how to actually find the setups and get into the trades and all that. So that's what I'm actually here to show you. So the first thing you need to do is we're just going to talk about choosing less pairs on your watch list. I trade Forex and I trade gold, and the best advice I can give to you guys is to trade less pairs on your watch list, because when you trade less pairs on your watch list, you can actually focus on what's it called? You can actually focus on the pair and actually learning the pair itself. Sorry, that's my phone. So the first thing we need to do and go over is market structure. And I made other videos on market structure. You guys all know those blue circles are the structure, and it's called the eclipse tool. I use this tool to identify my highs and lows, which are market structure, which is the trend. And you can use it on TradingView. I just use it because it's easier to spot the trend versus the lines. And so yeah, so right now we're on Australian CAD, so I'm actually gonna go to another pair. All right, so we're on UJ. All right, this is more of an active pair that I'm actually looking at. So the blue circles, like I said, are the trend, and the blue boxes are my fair value gaps slash supply slash demand zones. So the step number one is, like I always say, it's market structure. We're gonna write this down and do this fully. Market structure, and I'm not going to go over that because I have another video on that. So market structure is the first step, which is the blue circles that I have. That's your structure, that's your trend, and the trend is bullish in this case, right? So the next step is identifying your current range, and that range is going to help us find the actual trade so we can actually make money and do what we want to do, right? So the market structure is done, and let me write down the next step. Identify range. I want to do this really slowly so we can all just understand what I'm talking about here. Identify current range. So your current range is your current high and low, right? So as you know, market structure is made up of our highs and lows, the most relevant ones, because there's a lot of internal structure that does not matter in our case. The 1 hour chart is what I use for usually my market structure, and I zoom all the way out. So our current range is our current high and low, which is the um, bottom right here, which is where I just drew the blue circle, and the top blue circle right here. That's our current high and low because that's the highest high and highest low that's actually relevant. There are other highs and lows like this one in the center and all this stuff, but that's not the highest high and highest low. So once you have the highest high and highest low, you're then going to take this tool called the GAN box. And what the GAN box is, this is basically going to divide our current range in half so we know where to look for trade setups. So we're going to start by using the GAN box tool, and we're going to click the bottom structure, and we're going to drag it like this all the way up to the top structure, right? And you'll see 3 green lines. And I think you can change the color of it. Should I do that? Yeah, I changed it to red. So you'll see 3 red lines, right? And this is us identifying our current range. That's a step. Well, actually, no, it's not. Technically, it's not. So our current, we have market structure first. Our current range is the current high and low, which the arrows are, right? That's where the arrows are pointed to. That's the current range. And then the third step is, which we're doing now, is we are, um, sorry, not, we're looking for we're looking for where we're going to buy. So if we're buying, we're looking at discount levels. So the bottom half of this range would be our discount levels, because it's where prices are cheap. Because if you look to the right side of the screen, you'll notice that prices are cheaper right here where I just shaded. So we have, like, when we're at 157, 58, 59, and as we go towards the top part of the range, which is here, the unshaded zone, it gets 59, 60, and it gets higher in price. And so this, like I said, the Gambox tool just divides the range in half, and it differentiates premium prices versus discount prices. Discount prices are where prices are cheap, the low part of the range, and premium prices are where prices are expensive, the high part of the range. Sorry, my communication is just off today. So yeah, so the blue shaded area is the area that we are looking to trade and looking to find our setup, or to find our trade. So right now we're on the hold on a second, guys. I'm gonna have to turn my fucking laptop fans on because they're fucking, I don't know why my computer overheats and shit. So hold on a second. Hold on just 1 second, guys. Feel free to just skip this part until I get back to the example. Alrighty, so now that we know where we're gonna look for our setup, which is the bottom part of the range, which is the discount price levels, we are gonna go into the specifics and delete that, right? And so let's look for, I already pretty much did it, so I'm just gonna show you guys. So the blue boxes right below are the current price levels that I identified as my trading entries / trading demand zones that I'm expecting price to react off of. So the bottom one is the lowest zone, and then I have another one here on the 15 minute. So the bottom one, we saw price came down with a wick and tapped off that before going up, and on the 15 chart, I actually marked up a fair value gap / demand zone, and that's actually what I'm expecting to get into a trade into. So what you're looking at on the screen, the fair value gap is when there is supply and demand in the market moves, right? When there's demand, the market moves, and when there's supply, the market will move. Without volume, there is no supply and demand zones. And the reason why I'm saying that is because volume creates movement. Without volume, there is no activity in the market, because the market is made up of money, of capital, right? So we need money to enter the market so we can actually make money and trade. So for example, down here, the low blue box, which is right here, price came down and reacted off of that because this is where the lowest point of demand was. And then so when it tapped into this demand, we had money come into the market, causing the market to move up like this. And so when the market has actual demand, it doesn't necessarily have it leaves these gaps behind because it doesn't have time to fill them, because it's inefficient price action. Healthy price action is when a market will go like this: up, down, up, down. I said this in other videos: up, down, right? But then when we have an unhealthy market, which is the second example I'm going to draw, we have up movement, a little bit of down movement, up movement, a little bit of down movement, up movement, a little bit of down movement, up movement. So that's the difference. And they don't look the same because where they retrace / where they make a correction from is usually 50% of the range when it's a balanced market. But when the market has such high volume and high demand, it doesn't necessarily always have time to come back down and fill the complete range, and it will leave behind these gaps as a result of that, which are these, right? All that inefficient price action, that unhealthy price action. And so it's not that these gaps are never going to get filled. It's that in that moment, there was so much demand in the market that the market didn't have time to, it's not going to go back down and fill in every single little gap. But when the market settles back and it's made its move, the market actually does often come back and do that. So that's pretty much what I trade. I trade these fair value gaps and I trade order blocks. And fair value gaps, like I said, are made from demand. You need demand and supply to move the market. So as I'm a Forex trader, I use the economic calendar to show me high impact and low impact news. And so the high impact news is what makes the market have volume and makes the market move enough so I can trade. Because we don't want to trade a market that just moves sideways like retail traders do, because the market doesn't move that much. The market only moves when there's news. So we need news to move the market to make money. And so right now, the 15-minute example, which is, by the way, whenever you're marking up a demand zone, always have it labeled. So I have it labeled by 15 minute. The bottom one isn't labeled because of some reason, but I'm pretty sure that was like the 2 hour. So the bottom one is this one says 15 minute. So that's the time frame I found it on, which is this time frame we're on currently. And you'll see what happens is price will continue to go up like it did and make all this liquidity, which is this trend line. And I use liquidity as my take profit. So liquidity meaning Liquidity can be your double highs, your double bottoms, double tops, trend lines. Those are all liquidity because that's where retail traders are trading off of, and that's where retail traders have their stop loss. And so what I usually do, if I'm going to trade this 15-minute gap and I'm going to set my risk to reward, which is right here, let's say I'm going to trade that demand zone because that's where price started to move. That's where the demand started. Let's say I'm going to trade this. I need price to come down and take out this liquidity, like liquidity grab. I need it to take down that. I need to disrupt this trend by breaking that trend line and coming down to fill up my demand zone, and then I'll target some liquidity above. And that's usually what I do to trade. I look for my market structure to tell me my trend bias, and then once I have my trend bias, I identify my current range, the current high and low that price is in, and then if I'm buying, I look low. I look at the low part of the range for fair value gaps, and if I'm selling, I look for high parts of the range for fair value gaps, and that's literally all I do. It's not that hard. And so when you identify the fair value gap, it depends on the time frame is what you want to trade from. So if you find one on the 45-minute or the 1 hour, since that's a higher time frame, I'm actually not going to be trading those. So let's say I found that 15-minute box right there. Let's say this was the 1 hour chart. So if this was the 1 hour chart, what I would do is I would mark up that gap, but I would go to the smaller time frames and I would kind of refine it so I can actually enter off the gap so it doesn't break my risk to reward management rules. And so the same thing can be said on gold. You see how gold is labeled with those blue boxes? I have the circles, which is my market structure, which the trend is bullish, and I identified my current range, which is this high and this low. And so I can do it again. I can take the Gambox tool, and I know this is a little bit confusing for like a complete newbie, but just bear with me. I can take my Gambox tool and drag it from the low to the highest high, which was right there. And then what I'll do is, okay, I'm buying. So should I buy all the way down there, or should I buy right there where it says the 2 hour gap? Now gold, since it's gold, it moves a little different. Sometimes gold doesn't always go and come back down into the range. So what to do to help you guys is to go to the 1 hour chart, and I want you guys to notice something. The trend was actually bearish, and then it turned bullish again. The trend was bearish here where I'm pointing the arrow because we had a high, a low, a lower high, and a lower low. And from this lower low, we had price come back up. Okay, that's cool, but it's still going down, right? But then price shot up here. All this movement right here, price shot up. And then when price shot up, it took out this high and it took out that high. That is called a break of structure, a disruption of the trend. Because the trend, this miniature trend, the short-term trend was bearish because it was moving down. And so whenever there's a break of structure, there's usually unhealthy price action. So there was two examples of an unhealthy price action left behind that I drew with the 2 hour chart, down here and down here. Now, in my personal opinion, I don't think price is going to come all the way down to here, and the reason is because if price, demand going up, if demand lost its momentum, it wouldn't have made this big movement right here that I'm circling, right? You see that little movement there when price just shot up again? That means that price has even more demand. And so usually when that happens, I'll trade my most recent demand zone rather than the one on the bottom. So when I'm trading gold, it's a little bit different because when there's a lot of demand in the market in gold, it will just keep going up. It will go up, down, up, down. Remember what I showed you in the model earlier of it going up, coming down a little bit, going up, coming down a little bit in a high demand market. And that's the example of this one, because for gold it went up, came down a little bit, then it went up again, versus going up, down all the way, up, down all the way. It did the first example. It went up, came down a little bit, then it went up. When you have a lot of demand like that, that's what will happen. And then instead of trading and waiting for price to come all the way down in the range, you actually don't do that, and you wait for price to come down a little bit and find the most recent demand zone and then trade it off. That's why most traders will like miss their setups. So, yeah, that's pretty much what I have for today. For gold, this fair value gap is what I'm looking to trade. So the fair value gap, again, unhealthy price action. When we have these large candles, that means there's high volume in the market, and it will actually leave a gap behind, because the gap is where the wicks don't touch. So like if we look before that circle area, we can see that the market went up, came down, the market went up and came down. Everything looks all clunky because the market filled in inefficient price action. But right there, this exact area, this is the actual gap itself. The blue box that I just shaded, that's the actual gap. But the actual, to fill the gap, price would need to come either, hold on, I'll show you. Price would need to come all the way down to where that candle is, right there, at that candle wick. That's where the gap wasn't filled. Or sometimes prices won't fill in the actual wick, and it'll just come halfway, and then it'll do that right here in the actual zone. And so if I was trading this, what I would do is I would drag this box, and I would first fill out the actual gap, and then I would drag it all the way down to here towards 50% of that gap. And you have the option to trade 50% of it, or you can bring the box even closer to the actual wick and trade that and make that your entry. It really depends on your stop loss and what you could afford based on your risk management. So for me, it's like 10 to 13 pips of a stop loss. So what that means is that my entry is based on if I can afford that, a big enough stop loss or not. Which in this case, we're on the 1 hour. So I would actually go on the 15-minute and look at the same gap, and then I can actually refine it more. I can refine it more. And by refine, I mean I can just go like this. And so we see an even lower gap right here, which is where that wick touches. And there we go. So I don't know if you guys can see that, but what I just marked up was the actual wick and refined it. So the gap, like I said, is the space in between these candlesticks. As a result of unhealthy price action, it leaves that's why it's called a gap. The gap is where the candles did not touch. So this example, that shaded blue box, the space, the area and space of that is the actual gap, because there's no candles in between this blue box that's touching each other. Examples of candles touching, example of a gap that's been filled looks like this example right here. You see this, how price shot up in that giant blue candle, and then what did price do? Price came back down with that gray candle, and it filled in the gap by actually touching this candle and going in and tapping into this demand zone / this candle, and then it went up again. So that should help you simplify it. And so for this video, you're going to have to watch at least 2 to 3 times, because I was kind of all over the place. But yeah, so this is an example of a filled gap right there, where I have the arrow, the new arrow. I don't know why it's being all fucking dumb. Okay, so hold on a second. So this arrow that I have here is where the gap hasn't been is where the gap has been filled right here. And in this example, the gap hasn't been filled. Can you see the difference? There's, in this first, the big giant blue box, there's no candlestick wick coming in to this zone at all and filling out and touching this candle where the gap started from. There's no wick in here. But in this example, the blue box, the gray candle comes down and taps into that blue box, and there's a wick right here. This wick fills in the inefficient price action. This is the inefficient price action. The blue candle moving up so fast is inefficient price action. And so that's the whole point of trading gaps. You wait until you mark up your gap, and then you enter off of here. I would have entered off of here, and I would have had my stop loss like this. Like this. And then I would have depending on where my liquidity was, I would have took profit up here. Alright. So like that. This isn't a real example, so I would just take profit right there. And so that's how you would actually trade the gap. Alright? And so for your stop loss, I usually will target the end of the candle, so the candle body, which will be right here. Or some people will do the whole candle, but that to me is too much. I just do the candle body. The candle body is right here. Okay. But yeah, guys, I hope you guys found this somewhat helpful. I know it was kind of hard to understand because just my head's just all weird today. I'm gonna try to make a more simple example tomorrow in the morning. But if you need to watch this a couple of times, if you still can't get it, just message me and I'll help you out. But yeah, guys, I'm gonna go ahead and end the video here. Just remember, market structure first. Then you identify your current high and low, which is your current price range. Because when price goes up exponentially and just shoots up, it creates a range, right? Because the bigger the candle, the bigger the move. When you see these giant candlesticks, it moves up or down at a range. And so that it's a price range. The range between the high price and the low price. Like the example, the in this one that we just drew with the actual risk to reward, the demand started here and then it ranged up. So the top of this range would be the high that it ranged and it stopped, and then the bottom part would be where it started from. That's like my hand. Look at my hands. This is your range. Price started at the bottom and shot up to here, and this is now your range, and you're looking to buy within that range, and that's how it works with fair value gaps or demand zones. But yeah, guys, I hope you found this helpful, and peace.